Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This past week, I got my financial plan done. I've been on my own for the past 15 years, but considered getting a fee-only, meaning paid by the hour, financial advisor to look at my portfolio and plan to get a second pair of eyes on it every couple of years. The paid by the hour advisor is the only one who won't take your portfolio over and does not have a conflict of interest, but it will cost at least a couple of $1,000s, so I haven't done it. Usually this type of advice is reserved only for people with significant portfolios, otherwise it's just not worth it. So of course the other ways financial advisors get paid is either a commission from sales of mutual funds, and then they get 0.25% to 1% trailing fee per year. Some get paid by the transaction, some get paid, it's also called fee only, but they get paid as a percentage of assets. But then they do take over your portfolio. They sell all your stocks to put you into what they prefer, which is good, but it will force some taxes. Now, Wealthsimple, because I have over $500,000 with them, gives me little bonuses here and there, and having access to a financial planner, not an advisor, because it wasn't in her scope to look at individual investments, is one of the perks, which was awesome. So I gave her my information. You can look at it at www.canadianmoneytalk.ca, my portfolio. And I gave her my high-level plan of living off tax-efficient Canadian eligible dividends, starting in RRSP Meltdown at 60, not expecting much CPP and no OAS, and then donating my non-registered taxable assets to charity in kind at the time of my passing, and of course giving anything not taxable to the last person that was nice to me. There was no question I wasn't going to run out of money, so the financial plan didn't have to concentrate on that. I just wanted a few things. I wanted her to go through my portfolio if possible, confirm the RRSP meltdown starting at 60 years old to level out my income over more years for the RRSP. I wanted her to point out anything that made her pause, mistakes, or even alternatives, and then have a debate where I was planning on explaining why I'm doing things in a certain way. I also mentioned that I was not trying to maximize government pensions at the cost of higher taxes. So, for example, I could probably make it so my old age security wasn't clawed back, but if I had to pay a bunch of taxes up front for 10 years earlier to do that, leading to a net loss, that wasn't something I was interested in. I wanted to maximize the total money that I can use. I did want to look at tax efficiency, and I wanted to confirm when to start old age security and CPP. I was told a long time ago to start both early as possible, the CPP at 60 and old age security at 65, which is contrary to a lot of advice because you get less OAS and CPP if you start early. So I got access to their Conquest planning software, did my risk assessment, entered my assets, income, expenses, and the software gave me an assessment as well as coming up with some suggestions. Apparently, I am more than ready for retirement, and I will leave behind a princely 13.1 million legacy at 95 years old, which is a little higher than the 9 million another plan said I would leave at 90. Note that these numbers are not adjusted for inflation and therefore are not as impressive as they sound. Other suggestions were to redeem high tax investments first, which is fairly standard, to let growth happen tax deferred on RRSP and TFSA. This reasoning applies more to the TFSA because it is zero tax. The RRSP meltdown is redeeming high tax first, since all RRSP withdrawals are taxed fully, and it is what I was going to start at 60. Note that usually anything tax deferred is suggested to be withdrawn last to keep the tax deferral going as long as possible, the opposite of what was suggested to me. I'm supposed to do a dividend from the corporation to my personal, which I am doing already, and I actually higher numbers, and to start CPP and old age security at 60 and 65 respectively, getting smaller amounts earlier, which is because of my high RSP amount, about 400,000 today, which could put me into a high tax bracket once I have to take it out at 71. The other reason to take CPP early is because the amount I receive is based on contributions, and they drop the worst 8 years for the calculations of how much I am going to receive. I paid into it at the start of my career, but I haven't paid into it for a long time. So if I were to take it later, it is just adding to the zero contribution years. I'm supposed to give 100,000 per year to charity for tax purposes, and of course because I want to give to charity, rather than leaving it until my passing. Although I'm not a huge fan of this, since you never know what will happen, and I'd rather do it once I have reached the quote-unquote finish line at 95. It is suggesting TFSA top-ups. I am maxing out my TFSA every year even now. And it is suggesting to save to my non-registered accounts, which, yes, that's where any leftovers go. The financial advisor had follow-up questions, which I answered in my usual long-winded way. And after she reviewed everything and updated my plan, we had a nice Google video call where she took me through everything. The assumed annual return on my assets was just 7%, so nothing too risky, and I was okay with that. The summary of the plan and suggestions was, quote, your current plan is based on the assumption that your retirement income is based on your eligible Canadian dividend payout. You are planning to donate all your corporate investment at death to minimize the tax liabilities. By doing so, you are having high exposure to Canadian dividend equity, which is highly concentrated in Canadian banks and the energy sector. That is missing out on the opportunities of diversification. Tax on dividend income is paid each year, while capital gains can be deferred for a long time. I understand your dividend income from personal investment is maintained in the lowest possible tax bracket. As your investment keeps growing, a 20% capital gain rate is probably still more favorable than a 19% dividend rate when taking this into account. The high exposure to Canadian stocks is very true, but it is because taxes are lowest on Canadian eligible dividends. So I am doing what the government strongly suggests: invest in Canada. I am trying to diversify globally in about a third of my investments, however. It is true taxes are paid on dividends and I cannot stop the dividends from coming, so I do have only limited control, but I do need some income to live on anyways, so if I am getting money out of the portfolio, I'd like to have it be tax efficient. And it is true that for most provinces, somewhere in the 110 to 130,000 income range, capital gains are taxed less than Canadian eligible dividends, so additional income should be in capital gains. So point well taken. To this, the advisor added by email, quote, I still think donating to charity during your retirement would be the best way to maximize your total donation and minimize your total taxes. A consistent 100,000 per year donation to charity is $4 million in 40 years, plus you would save about $6 million in taxes in these 40 years. In this case, your net estate has only decreased by $8 million. End quote. I understand the reasoning, but since you never know what will happen, I'd rather do it once I have no further use of the money, but it is something to consider and I will keep in the back of my mind. The final plan showed leaving a legacy of $32.5 million at 95, which is an improvement from the earlier, although as long as I don't have to go back to work, I'm fine. And $13.1 million versus $32.5 million donation to a charity is just changing the size of the plaque at the SPCA headquarters. My assets are going to continue to produce amazing cash flow, although I'm not expecting to get much in CPP and definitely will have all of the OAS clawed back, so that part of the cash flow seems unlikely. The final summary is here, covering what I mentioned before, except that I can increase my retirement expenses sixfold, which seems extravagant and a little high. I also verbally confirmed the RRSP meltdown strategy, starting to withdraw from my RRSP at 60 to even out the income and spread it out over time, rather than have my income spike at 71 when I have to start taking the RRSP money out. And the best part, I can continue to check in with Wealthsimple's financial advisor year after year, and I will, for free, as long as I have the $500,000 with them to get the plan updated. I never had a financial advisor who updated my plan the following year as projections became reality, so I will definitely take advantage of having someone else other than myself look at my finances. In general, financial planning is important and is not one and done kind of thing. If you haven't had your plan done or updated recently, I would strongly encourage you to do so, if for no other reason than to confirm that you're on track, or to start making changes to income, expenses, and return expectations from your portfolio sooner rather than later while you still have time. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.